Hey folks, Dan Frio here with your closing bell for October 22nd, 2024. So mortgage rates, as you see, they went up just a tad. The 15-year went up more than most, but we don't do a lot of 15-year terms. So let's just say mortgage rates are flat today. Thank goodness. Whew. And we dodged a bullet once again today, but we finally are getting some clear way on what's going on behind the scenes. So here's what we're looking at. So if you looked at this as the economic news for the week, there's really nothing here to kind of say, well, mortgage rates should spike because of this, because let's just go through it real quick. So I got to put my glasses on because I'm an old fella, but right through here, U.S. leading economic indicators. Well, that's not enough to make the markets do what they're doing with rate-wise. It was previously came in at negative 0.3, it went to negative 0.5. That's about it. Tuesday, nothing here. Wednesday, which is tomorrow, we really have nothing here as well. And then as we go through the rest of the week, really, we're not getting any real data that should affect the markets, and especially interest rates, until Thursday. Thursday, we have right here continued jobless claims and initial jobless claims. This is in the wheelhouse of what the Federal Reserve's watching. And then on Friday, we start having some of the data that they're interested in as well is core durable goods and durable goods orders. That's it. So I'm trying to figure out, why did rates take all of a sudden, they went up like 0.5% like that. So there's a bond trader right here. They just interviewed him on CNBC. Fantastic interview. The bond market's a little bit quirky, and you got to really know a lot of the intricate details on the back end of it. So they're going to say a lot of like some terminology here that might be a little confusing. I think you'll get it. So the gist of it is they're saying, well, the economy is just too good. You know, the Federal Reserve, even this morning we were talking, it's like the Federal Reserve is looking at numbers like this, and they're saying, okay, why should we cut? We have inflation that was way up here at 9%. Now we're in almost the 2% range. We have the unemployment rate basically at 4%, and that's historically right where they wanted it to be. And we have GDP right behind my head that's an astonishing 3%. So we have a fantastic scenario behind the scene. Just the bad news is the federal funds rate's too high, so the Federal Reserve wants to bring this down to net neutral, whatever that's going to be. So let's take a quick watch of this interview. And I think you're going to find it really informative, and finally maybe tie some of these loose strings together to maybe make it make sense. And that's the point of this whole thing. So let's get to it.
Joining us to discuss is Zoe Financial CEO Andres Garcia Amaya and Joe Lavorgna, who is chief economist at SMBC Nikko Securities America. It's great to have you both here. Joe, let me just start with you, because I know you share some of these concerns and are looking to see rates moving higher on the short end, on the long end, pretty much everywhere. Is that right?
Yeah, well, yes. I mean, in the short term, the bias is going to be for higher yields. Kelly, when the Fed cut 50, as we thought they would, the market tends to sell off because the market starts to discount faster growth, and we've had much stronger numbers. And about 70% of the move we've seen in yields from where we were when the Fed cut to now has been in higher real yields, which is reflected in the term premium. That is partly a function of better numbers, which we could talk about why we're getting the better numbers. I don't, with all due respect to Mr. Jones, Paul Tudor Jones is a great trader. I do not subscribe to his view that, you got to sell everything and the fixed income market isn't where you're supposed to be, because as bad as our U.S. fiscal finances are, if you look at Europe, you're seeing yields there significantly below where the U.S. is, with much worse long-term budget fundamentals.
Right. But so what is your argument that you would own parts of the U.S.?
Yeah, absolutely. For sure. Yeah, I think we could we could, depending on who's in office and what the policies look like, we could get rates moving back toward 5%. I don't think we'd meaningfully go above there. Interest rate differentials with Europe would be much too wide. And of course, as yields moved up toward 5%, investment grade corporates, which would provide a very attractive compelling return versus equities, would move up to 6. The equity market would correct, and then we'd undo any policies that were pushing us sustainably toward 5%.
I mean, in fairness,
So basically what he's saying, and she has a thing to say about corporate debt, which is really good, so I might rewind it just a tad. He said everything looks good, but what's going to happen is with the administration change or whatever, there's not a lot of fiscal policy there, so they're expecting yields to tick up a little bit, and that is going to play a havoc on the equity markets as well. Eventually, that's what he's saying. So interesting take on that one.
Corporate credit is doing wonderfully. I mean, I think spreads are tighter now than at any point in almost the past 17 or 20 years. And maybe the spread with Europe is deserved because Germany is in recession, basically. So, I mean, there's...
Yeah, I'm talking, Kelly, on the 10 years. I'm talking 10 years, where the spreads there would imply they'd be much wider. And I'm saying that doesn't make any sense if U.S. yields were moved up to 5 or say 6%, given the spread, say, in Greece and Portugal, Italy, where they'd be 200, 300, 400 basis points, the dollar would massively rally, and that would abate any inflation pressure in the system.
Andres, you're not as concerned, I think, about what's going on with the financial system overall. I mean, you're pretty sanguine and see a lot of positive things that have been driving us to these levels. So you could buy stocks, you think, here? I mean, what's your kind of formula?
Yeah, one.
See, it's not just me and you guys out there trying to find direction with this. Look at, we have this morning, I think I mentioned a few Fed officials. They don't know how much they're going to cut. Then you have people on Wall Street and analysts. They're like, okay, we don't know what the Fed's going to do. The economy's looking pretty good right now. So what's the Fed going to do? What's the presidential election going to look like? What's this good? So there's so much uncertainty out there. Within a couple weeks, we'll have a little certainty there, hopefully. And then hopefully the markets just kind of start, getting back to what, like I said, whatever neutral or normal might be. So let's get back to it.
One thing in the Treasury market that's important to note is that it's also different to buy a Treasury bond that has 4% yield versus maybe when it was a 2%. Like there is some protection that you are getting a 4% coupon, right, versus when it was 2. So there's a little bit more protection even if it goes up a little bit higher from where it is now. When it comes to stocks, my view is that just because we're at all-time highs doesn't mean that it should sell off, right? Especially if your time horizon is 5-10 years out. I think there's actually a fair amount to be optimistic about why the market is going up high. One, it's earnings. Earnings are delivering. The other one is, which often gets talked about, is the Fed is cutting. The economy is not in a recession. It doesn't seem to be heading into a recession. And that's a pretty good recipe for the markets to continue to move up higher.
Even though valuations, this was the argument from Goldman's Costin this week, saying we should only expect 3%, average returns over the next decade.
Right. I think valuations start to become a very good indicator of what to do when they're at extremes, right? And yes, they're above historical averages right now, but it's not in that red mark of maybe where 2000, was saying, hey, this is now time to really consider valuation. And I think that note also implied that it was still going to go up for 12 months, but then eventually go down. For someone that's looking to invest 5-10 years out, rebalancing would kind of take care of that in itself.
So it almost sounds like both of you think there could be a good entry point here for the 10-year with yields where they are. You don't think, so you'd be comfortable owning it, Andres, at this, roughly at this level?
I would say that I understand why there are concerns that there upward pressure to yields. It's just a question of, is that upward pressure more than the 4% that you're getting on the coupon? And from that perspective, I'm not as concerned as I was before when it was with a 3 handle or a 2 handle.
Joe, do we need better talk or indications from either potential new administration on what they're going to do with the deficit and the debt? Would that help kind of tame the rise in long end yields, or at least kind of leave us with the good factors pushing it up and not the bad ones?
It's possible, Kelly. And also, I'm probably a bit less sanguine on the economy than others. Even though growth has been better than expected, a lot of that has been deficit fueled. And I think at some point, the incremental dollar the government's spending in terms of how it generates growth is going to dissipate. So I do think the economy will soften. And with that, Kelly, it should take down inflation expectations and should ultimately bring 10-year yields back down to 4%, which is basically where we see fair value. If yields were to move up substantially further from here, it would be a buying opportunity.
All right. Andres, what about gold and Bitcoin as
we're going to leave it at that. So one of the takes that they said in here is as an investor. I don't know if you caught that. As an investor, both these guys, they'd say, we look at a longer term horizon, maybe 3 to 5 years. So we talk about that all the time when it comes to buying your house. Even traders don't do that. They're like, okay, if I buy my stock right now, what's it going to do next week? Don't know. But if you're you're an investor, not a trader, you invest for the long term. Just like buying a house, you buy now and 10 years from now, you'll probably be like, I don't even know what I paid for it. So that's it. I'm not saying you have to buy a house or not even have to buy stocks or anything. I'm just kind of trying to tie all this together to help you guys understand the markets and how they're related. So that's that. Let's go to the CME Fed Watch tool. It ticked up just a little bit, saying the odds now are a little bit higher that there's a 0.25% cut in rates coming. And then let's see how the equity markets ended the day. Let's do one last refresh. And there's a lot of red up there, folks. Dow posts back-to-back losses Tuesday as Wall Street rally pauses. Well, I'm not going to say really a -6 is bad or a -2. Plus 33, I'll take it, Russell. So it's basically flat right across the board. I wish that would happen to mortgage rates right now. So here's our mortgage rates are finishing the day, folks, right through here. These are the top 6 products people use. But let me explain what these are. These are not my rates. These are actually published by Mortgage News Daily, and they do this every day. What they do is they send out alerts to all banks all throughout the country, and they ask them questions on, if you had a specific buyer, what would the rate be? Well, there's actually 5 main questions that they ask in this survey. One is the person needs to be a first-time home buyer. They're going to buy a single family, and they're going to live there. Okay, that's the first 3. The other 2 pieces of that equation is right through here. These people are putting down 25%, so they have a mortgage of 75%, and they have a credit score of 780 or higher. So if that's you, that's not most people, but if that's you, that's most likely what your rate's going to be. If that's not you, well, check out my website. I'd love to help you. My name is Dan Frio. I'm a mortgage loan officer licensed in all 50 states as well as Puerto Rico. I'd love to help you maneuver buying your first house, maybe buying your first investment property, maybe even possibly refinancing. We were doing a lot of refinances there right before the rates went trickled up, and now those depleted a little bit. But if you're looking to buy that first house, you got to check out our grant finders. Okay, there's grant finder programs right up through here. There's national 3 that we handpicked. There's one in the Chicagoland area, so check those out. If you want to get the ball rolling, just click the Apply Now button. Or if you'd like to reach out to me or one of my teammates and just ask us some questions, you can do that as well. Just scroll down to the bottom of our website, and all that information is right there. If you want to give us a call, 844-775-5626, or you want to email me personally, you can do that at dan@therateupdate.com. Thanks so much for watching, folks. God bless. Have a fantastic evening. I'll see you back here tomorrow. Bye-bye.